So today we're going to be talking about dividend investments versus growth investments, or otherwise known as dividend stocks versus growth stocks. So this is like the Mike Tyson or, whatever. I don't know anything about boxing, but, two heavyweights. You've got the modern growth. Most advisors I talk about now, like dividends are a thing of the past. Let me just talk about growth. Let's dive into the lesson and see potentially which one does better. If you've done any listen to any of our lessons, you know which one's probably going to win. So dividend stocks, let's just be clear right out of the gate. These are companies that pay a regular dividend. And then you have growth stocks. These are companies that reinvest their earnings rather than paying a dividend. So most companies have some form of profit, right? You'd hope so. Some pay that out and some don't. So that's the big difference here. Growth stocks are ones that don't pay it out to their investors. So this is the difference between these two. All right. So we're going to focus on total return. This is super important to our discussion today. So I want to make sure it's in context of what we're doing. This is price appreciation plus dividends reinvested. So if a growth company is not paying that out and they're just reinvesting to rise their stock price, that's total return. So it's just their stock price, what you bought, what you're going to sell for it. If it's a dividend stock, then you have the price plus the dividend that can purchase back more shares. You get to the same conclusion. So as long as we use total return, we can have a fair fight because we don't want to talk apples to oranges. We want to talk actual return in both situations. All right. So I want to frame some perspective here. This is really important. And the reason it's supposed to be a V. The reason why I want to do this is we have this really bad tendency as an advisor to really focus on gains and losses. So if we look at a stock, we bought it at X, we sell it at Y. And when we do our reports and when we do some form of review, we're looking at necessarily gains and losses. But from a client's perspective, who really matters, they just focus on what they actually keep. This is the most important, like what hits their bank account, what's on their statement. Sometimes we speak apples and oranges. We speak a foreign language because sometimes these don't necessarily match up. And I just want to make a point of that. I have an issue at times being very what I would consider black and white, but I'm speaking a different language of black and white than what my clients, because I'll look at my portfolio. I'll look at what the generalities of the portfolio do, and there's specifics to clients which are always off because when they buy a stock will determine on what they're doing, on any calendar date versus what the actual portfolio is going to be doing on the calendar date. This might be a moot point, but at the end of the day, you want to make sure that you're speaking the same language to a client, because sometimes I have in my mind what I'm communicating, but they're hearing something completely different. And that's why I want to make note of here that it is important to understand the facts, but it's also important to be able to interpret them to the client. All right, so let's look over decades. So we're going to look really quick about the different decades, starting from the 70s to present. 1970s, dividend payers. So these are the dividend payers, and then these are the non-dividend payers that you're going to see over the same decade. From 1970, so 70 to 79, dividend payers averaged 7 to 8%, where non-dividend payers were 3 to 4. That is a pretty significant, double the return in the 70s. 70s is a lost decade. The market just started at a point and ended at a point. Nothing changed. Yet the growth stocks averaged about 4%, 3.5%, where dividend stocks averaged about 7.5%. In the 80s, it's when the big boom started, right? Dividend stocks did about 17.5%, where growth stocks did about 14.5%. Again, pretty significant difference between the two. Clear dividend winner right away. And now on the 90s, you're going to see Dividend stocks do a little bit less, where you have 15, so 15.5 versus 17.5 on growth stocks. 2000s, you're going to see dividends did about 2% over that decade. I would argue it was more than 2%, but we got this information from a research company, so I'm not gonna debunk it, but I actually think it was a little bit higher than that. Where growth stocks for an entire 10-year period averaged a loss of about 4%. A loss of 4% over 10 years. That's crazy. I started my career right here. And growth stocks lost, and I wasn't doing dividends back then. My average client lost money over that 10-year period. Historically, I don't necessarily think they did, but the reality is the average investor lost money. The average growth stock lost money over that decade. Then you go to the 2010s to 20, where dividends did about 14, non-dividends did about 16. So you're going to see it was pretty relatively close right here. Dividends were much better than growth stocks, and then it was pretty close. These years, the growth in the 90s and 2010s, growth stocks outperformed dividend by about 2% total. And then in 2000, I mean, this was pretty big. The 2000s, that 10-year decade, I mean, growth stocks underperformed dividends by 6%. So you can see a pretty big gap where dividends have outperformed growth just in these 5 decades. It's pretty significantly, factually, just comparing dividend stocks that pay out their dividend versus growth stocks that actually, reinvest that capital to more appreciation. There's a clear winner that dividends won with 2 exceptions almost every single decade, and the ones that they did won were significantly lower than the ones they lost. Now, dividend stocks versus growth stocks. Look at 1970, 2022. This is kind of fun. So we're going to ask you to guess. What did growth stocks annualize? What was their annualized total return? This is a total return from 1972 to 2022. This is a huge window. And this is stocks that reinvest their profit to increase their price appreciation. What do you think that annualized rate of return is over between these 2 years so this is not inclusive of dividend stocks, because what we're doing is we're separating the two. All right. You want to guess? Drum roll. Most people will go pretty high here. I actually guessed very high. The answer is 4.8%. 4.8%. That is pathetic. I mean, that is a huge window. We're talking 50 years and only averaged 5%. This blows my mind. Look what dividends do. What are you guessing here? Dividends did 10.7%. You might have seen in some of my other lessons where I talk about the total return of the dividend inside of the S&P. So what percentage of its growth comes from dividend? Dividends are like 4% or less. All right. So when you look at the S&P 500, I mean, dividends like 2%, 1.8% right now, but historically it's been right around 4%, a little bit less. So you're looking at 4%, and then you reinvest that into those different positions that pay out their dividend, that maintain, being in the S&P 500. Which percentage? It's 52%. So dividends represent 52% of the total return of the S&P, and this is proof of it. Once you look at this, the growth stocks that don't pay out dividend versus the dividend stocks that pay out dividend, look at this is a monster difference. 6% a year average. I don't need to go over anything else, but this is pretty substantial. Next up, Dalbar studies, one of my favorite things to go over. And this goes back to the original note that I made about sometimes we look at gains and losses and our clients just look at what they get to keep. This study does a great job of understanding behaviors of clients. So this is in 2018, it marked the first time in 30 years that the Dalbar study had actual historical data from investors. So now it's close to 40 years. We're coming up on 40 years where they've been talking and watching the average investor versus what the actual markets are getting. So it's not what the markets are getting, it's what the investor's keeping. And this is what I was talking about earlier. So let's look at the study. So this is 100% all equities. This is diversification. I'll just put a big D there. This is bonds or bond equivalents. So most advisors live right here. Asset allocation, diversification. I don't know any advisors out there that is like, yeah, I want my investors, my clients in 100% equity. No diversification. I want them all in the market. That's this column right here. So everybody's going to look at these returns going, well, I want my clients to get at least these, or even better, the S&P. Well, that's 100% all in, because this is 100% as well. So this is the market true return of what the S&P did over that period of time. And then this right here, depending on the model of 100% equities, diversified, or bonds, this is what the actual return for the investor kept in their bank account, their portfolios. Why? Because they're emotional. I mean, over a 30-year period, how many things go wrong in the market? How many ups, how many downs, how many pandemics, how many wars, how many crazy things happen? And why is the market over a 30-year period doing 10% and the average investor only getting 1.65%? Because they're buying at the wrong time and they're selling at the wrong time. Because they're normal. The market's crazy and we don't like it. So when the market goes down, we tend to sell. When the market goes up, we buy. Now, we should be buying when the market goes down and selling when the market goes up, but we don't. And that's why the market does 10 and the average investor does 1.6. Go over 20 years, the market does 8, the investor does 2. 10 years, the market's doing 7. I mean, look at the consistency here. I mean, the consistency here is terrible. I mean, you're looking at -3. I mean, the best is 3.81 over 1 year, but the S&P does 15. I mean, there's just no comparison whatsoever here. This is pathetic. But this is real. This is historical data based on actual investor returns that they get to keep in their portfolios. This is what matters to me, is really understanding the client. I want to see from their perspective what they're maintaining, what they're keeping, because I want to know so I can better serve them. There's a solution to this, by the way. It's called tethering. I want you to think about jumping out of an airplane, hopefully with a parachute. I've never done this, but it's commonly known that the first time you jump out of an airplane, if you're going to, do a parachute, you're tethered to somebody who's done that before. You're going to be connected to them. They're going to be behind you. You're going to be in front. And all you have to do is just enjoy the ride. And then they're going to do all the work and pull the cord and understand. They might even have you do it, but they're going to tell you when. They're going to be looking at the altitude. And all you have to do is just enjoy yourself. That's what a tether means. That there's safety and security. There's something that intrinsically you're like, hey, we're good. No matter what, this person's going to make sure we land safely. That's a tether. So let me give you a different example here. If you're at a party in college and something like a break fights out, something scary, what do? If I think back to college, I was pretty conservative. I didn't go to too many or find myself into too many situations, scary situations. But I can tell you, in any event in my life, pre-marriage, where I was in a situation that I didn't like, here's what I did. I ran like Forrest Gump. I was out. I'm not a fighter. I'm a lover. I'm the type of guy that when something crazy happens, I'm out. I'm looking for my exits. How do I get out of here? Okay. Again, I've not been a real crazy guy, but in bad situations when I was younger, how do I get out of here? Let me ask you same question, just different circumstance. You're at a party with your kids and the same type of situation, two dads go at it, something bad happens, somebody shows up with a firearm, something crazy. What do you do? If you're like most, you're going to protect your kids. So in one situation in college, I split, I'm out. Same type of situation with my kids. I might stand and fight, or at least put my kids behind me. I'm not necessarily going to turn my back and run now. Things have changed. So what did change? Easy answer here. When you were in college, you didn't have kids. When you're married and you have kids, like, you're tethered to your family. Like, this is my family. If something crazy happens here, I'm going to defend my family. You want to get between me and my kids, me and my wife, we're going to have issues. I'm not going to run. I'm going to stand and fight. I am tethered to my family. I care about my family. It's a very high priority to me. So what am I going to do? I'm going to fight. But when I don't have something tethering me, what am I going to do? I'm going to run, fight or flight. Well, I know when I'm going to fight and I know when I'm going to flight. Okay. Well, when it comes to investments, growth stocks right here, there's no tether. Something goes wrong, I'm out. I've seen this for 25 years of my career. When somebody's investing in something and something goes wrong, a growth stock, market crashes. I think we're on the precipice of a bubble bursting in the market right now. Something goes wrong. I can tell you, those who are in growth stocks currently right now, what we're going to end up seeing, we're going to see a flight response where clients are going to be like, I'm out. Why do I always say, I'm not going to pay you to lose me money. That's what you're going to hear. But on the flip side, as we look at this, with dividends, we've got a tether. You know what it's called? Cash. It's pretty strong. It's like getting paid to do a miserable job. I can't stand my job, but I love my paycheck. You going to quit? Nope. I get paid a lot of money. I like it. I'm not speaking me personally. I'm just saying this in jest. I know a lot of people that hate what they do, but they'll never quit because of that paycheck. Very similar things here. They hate the volatility of the market, but they love getting paid in the form of a dividend. They're getting cash in the bank, and they're like, as long as I get that cash, I'm not selling. I'll deal with the volatility. I'm okay with the ups and downs because they're paying me to hold that stock, which is a pretty interesting way of looking at it. As long as you buy quality, this is a very interesting thought process. But I can tell you the key here is you're jumping out of your airplane and you got somebody behind you that understands how to get you down safely. And it's called a tether. It's pretty awesome. It's changed the way my clients invest. So let's talk about some more stats real quick. Roughly, what percentage of U.S. households own individual stocks? This is an interesting one. What percentage would you say? I went really high. I thought it was much higher than it is. The answer to this is 15%. 15%. 15% of U.S. households, only 15% of investors own individual stocks. That blows my mind. That means 85% of investors are likely not tethered to their investments. As an investment advisor, financial advisor, that's a lot of opportunity. So when things go crazy, when the market gets a little crazy, there's 85% of investors out there that are probably, and actually a good portion of the individual investors as well, aren't owning dividend stocks. That means the vast majority of the American investing public is upset, untethered. That means the ocean awaits you. There's tons of fish in there. And if you have a good strategy, there's going to be tons of money in motion. I know a lot of advisors that prey on bad markets. Why? Because they know money is going to be. I love when markets are bad because most investors are not tethered because they bought growth. And there's tons of opportunity here. A lot of opportunity here. 85% of investors, probably closer to 95% of investors are ready to run as soon as there's volatility in the market. Because of this, if we keep going back to the dollar bar, they're not keeping a good portion of market returns. If this was their return, we wouldn't be having this discussion. I'd be like, the average investor just ignores their feelings. They stay in the market and they make great return. But this does not happen. This does. Investors run. There's no tether. There's nobody to protect. They want to protect their nest egg. So they're going to run from loss. And that's why they're averaging pathetic rates of return. That's probably why so many investment advisors like you are watching videos like this, because you're like, there's got to be a better way. Because most money managers in the marketplace are horrible. All they do is charge you fees and lose your client money. And then you're going and hiring the next guy and the next guy and the next guy. I was there. Before I started doing it myself, I hired just about every good money manager out there. And it was one bad experience after the other because none of them did dividends. There was no tethering. There was just hey, I'm going to do this market timing, or I'm going to do this. And they would show all these amazing statistics of how their portfolio performed before I started using them. And the moment I hired them, it was like they were incapable of making any return. And I'm like, why does this happen? You can show me all these awesome sheets of how much money you make. The moment I hire you, you don't make any money. Every single time that happened, with the rare exception of a few years in there. All right. So I wish there was a Delbar study that showed dividends, like, something just like this. That was, here's what the S&P did, and then here's what dividend investors did. They had that, I'd be all over it. I've never seen it. I've been looking, I'm trying to get chat to help me figure it out, and I can't find anything. But there's a lot of awesome examples. Warren Buffett is a great one. I'm sure you've heard of this guy. Here's some of his holdings. These are the best estimates I could get. Here's the actual shares of when I got this, in the last couple of weeks. Owns 915 million shares of Apple, paying $1 a share. He's making $878 million roughly a year in dividend income. I mean, almost $1 billion in 4 stocks each: Apple, Bank of America, Chevron, and Coca-Cola. He's got these different shares. They pay this much. I mean, look at the amount of annual income. That is so much dividend income, real money that he can use to buy other shares. He can do so many other things with it. When you got $3.5 billion here worth of dividends in 4 stocks, it's insane. And then Kraft, 325, making $500 million. I mean, there's an enormous amount of wealth being generated just in dividend income. This is a guy who gets it. He's buying cash. He doesn't own a stock that doesn't pay dividends. He owns companies that own profit, that he's going to go buy those companies to turn that profit machine into an even bigger profit machine. All he does, his number one investing principle is to buy cash. He buys companies that he knows he can generate more cash flow from. But at the end of the day, all that he's doing is he wants cash flow. That's it. He doesn't want to buy. He's not into Bitcoin. He's not into growth. He's into cash flow. It's a pretty awesome model to follow. That's why I love it. I got into it years ago. I ain't changing. When you have a reason, this is super important. This is also that tether. When you have a reason, a tether to hold on to a good investment, I will also highlight good. Not an investment, a good investment, a dividend-paying investment, a cash-producing investment. The total return is typically always better. I want to put always, but you can't, because that's not necessarily always going to be. There's always going to be that one. Some guy writes me or gal's like, well, this investment didn't work out, so I can't put always. But most of the time, like 98% of the time, if you hold a good investment, really good investment, and you have that reason, that cash flow to hold it, you're going to have a better total return. I mean, we can look at it here. I mean, statistically, as long as you just hold things. And the reason why these returns are so high is because of the dividend inside of the S&P. If it was only, and I'd love to do this, if you just took the growth stocks out of the S&P, what would those returns? I bet you it would be way higher than this, because the growth investments are actually holding back the S&P 500 in the long term. Shorter term down here, not so much, but long term it is. Got ahead of myself there. All right. So last thing, there's so many advisors out there that love this kind of stuff. If you want a more immersed, like fast-paced, fire hose type of learning process, we've got a program for you called Advisors Ascend. It is basically everything that we do, soup to nuts. It's how we organize our calendar, how we get in front of prospects, how we convert to clients, how we plan through simplicity, our investment methodology and dividends, how to put together a portfolio, all the way through client experience, building the map, the journeys for your clients, and how you serve them, the experience that they get by being a client with you. Everything that we do mapped out, taught in tons and tons of videos with free handouts or with handouts that go along. This is a paid program. It's one of the only things that we actually charge for. You can go to advisorsascend.com, learn tons more. If you can continue to consume our free videos, we put them out all the time. I love teaching. We coach. We have lots of advisors that we coach and train. But this is, if you want to just get a quick head start on some immersive, you're never going to get these videos for free. But I can tell you they're worth the cost. And then if you want to engage with us in any other way, you can do that. You can always reach out to us at no cost. We'd love to chat with you, but check this out. It's pretty cool. Hope you enjoyed today's lesson, dividends versus growth. Hopefully the debate's over. There's no debate in my mind, but if you still have some questions or you think there's reasons why growth are better, please reach out. I'd love to discuss that, and I'll create another video about it. Hope you enjoyed yourself.